Hello and welcome to Monday Markets, brought to you by FTX on this fine Valentine's Day evening. I'm here recording a crypto video, so that tells you all you need to know about my personal life. That's not really relevant, I think, when it comes to the pre-recorded stuff, just to be clear. First of all, thank you for the feedback on the video last week. The short update seems to have been well received. And the reason I'm doing it again is because I'm not here to waste your time or insult your intelligence. What I mean by that is, if the market's done nothing, I do not expect to be able to meaningfully take up an hour of your time if I don't have much to talk about. So I could get the same content and get the same points across in 10 minutes, or 15 minutes, whatever it may be. That gives you whatever the remainder is to do with as you please, instead of listening to me ramble. So let's get into it. So in terms of the technicals, really not much has changed, right? As we discussed in the last update, the push into 43 to 47 was a push towards resistance. That's what happened to the market, and it closed at 42k or thereabouts. Now, this to me is generally uninteresting and unimpressive. I mean, resistance did its job, but it didn't lead to the market rolling over. If you want to really kind of read into it, you can see that despite testing and closing below the nearest level of resistance, the market kind of found some sort of temporary floor at lower time frame structure and the prior range low at 42k. So there's not a whole lot to write home about, right? So for example, if the market had reacted to resistance and then closed below this 42k level, we could make a stronger case for resistance by saying that resistance resisted and then the market also broke support. And then you'd have a stronger claim towards the market trading towards the next level of support around 38k. I still think that's reasonable, but just with how this candle close has taken place, the best I can do is meh. And by meh, I mean it's entirely foreseeable that the market pushes into this cluster of resistance once again, and it's equally foreseeable that the market pulls back towards 38k. Given how the candle closed, I don't have a clear read. It's a bit of a coin toss. Kind of resistance did do its job, but not persuasively enough to lead to a rollover scenario. And we can see that kind of on the daily time frame. The market came into this area, swiped the previous high, and it's kind of found support at this former range low, which looks very ugly on the weekly when we drew it, but kind of has more weight to it on the daily time frame. Now, whether this is some sort of inverted head and shoulders or not, it doesn't matter. The pattern structure is irrelevant. What you have is a range low, a bunch of price action below it, and that range low is currently providing some sort of floor once again. So I'll talk about the technicals very briefly, and then I'll just tell you how I'm thinking about this market at the moment. So in terms of TA stuff, when it comes to setups that make sense and or are attractive, at least the long-oriented ones, because longs generally easier to manage than shorts, in my opinion, or at least with my personal trading. If I'm in a short, I'll normally spend so much time figuring out management, take profit levels, etc., that I'll miss out on a much better long opportunity. So generally, at least for the sake of these live streams, I just think having a long-oriented approach, that's not to say directional bias, but just in terms of setups that are bullish, either above price or below price, that just tends to be more conducive when you're talking about crypto than trying to sell every resistance, right? So in terms of longs that I like, and I mean, it's pretty self-evident where resistance is anyway, so I don't need to make that case as clear. In terms of swing longs that might have some space or some meat towards them, if you will. As we discussed on several occasions, this 43 to 47 mid-range is just as relevant as ever. It's the former range midpoint, and we've got a bunch of other mean reversion targets around 49k, all that kind of jazz. And then there's really a kind of vacuum left from where the market made the top towards the range at 58k. Accordingly, in terms of bullish continuation longs, I would need to see a break through that confluence and those confluent levels of resistance, and that would need to happen at least on the weekly time frame, given we're dealing with monthly levels after all. So there's some time frame incongruity there that needs to be accounted for. But in any case, strength through resistance, and then either you get a very shallow pullback, I would expect, before a push towards the range high, or a kind of impulsive breakthrough. You get a period of consolidation, and then it doesn't let you in on a pullback and goes straight up. In any case, those types of momentum continuation longs, they must be predicated on the market being accepted and or finding support above 47k, right? And we're far, we're not there at the moment, but just in terms of, if this goes up sideways and then breaks up again, in terms of what's the long setup, well, it would have to be above resistance, because otherwise you're longing into resistance, which is not something I'm really a fan of, at least not in my trading system. So in any case, acceptance through 47, If this cluster then flips to support, I think there's a move worth pursuing, because I think it's mostly a free ride until the range high at 58K. And that would be your classic range midpoint reclaim into range high type of setups. That makes sense to me. Now, what about the downside? I think the only reasonable case to entertain, as I think Don has discussed elsewhere, is still predicated on this weekly and also daily 38K to 40K level, which is technically very significant and goes all the way back to this the 2021 range high. And you can see it's been a bit of a messy, granted, but still an inflection point nonetheless. And the whole premise is, if the market is going to, like it previously did, find a bottom somewhere in the 30K range, it makes sense for this impulse to make some sort of higher low. And that should be fairly self-evident, because the alternative is you get this impulse into resistance, and then if it doesn't make a higher low, that just looks awful, right? That's just a bearish retest, which is leading to new lows on a range that's been already tested 3 or 4 times. That's not a good picture. So the only way this could resolve bullishly, if it's not going to be above resistance, your only other option is to fish for a higher low. And in terms of high time frame structure, the first decent candidate for that type of higher low is this 38 to 40K weekly level. If I can select it, there we go. And it again comes back to this prior range high here. Now, what might that look like on the daily time frame? Well, that would be a fairly self-evident market structure type of setup, whereby this could technically be seen as a higher high, both on the closing basis and on a wick basis. And then the question is, where do you get the higher low? And the standout area is this 38K weekly level. So from a market structure point of view, you would have low to high, higher low, higher high, and then as the market's pulling back here, the question is, where could you expect a higher low? From a market structure point of view, yes, the nearest level is the daily 40K that we've discussed, but if we let that wick a little bit, or even if we simply employ the weekly time frame, the deeper pullback candidate for a higher low is the leg to 38K, before you get at least a retest of resistance, if not a rush into the range high. But this is the type of market condition, or the type of environment in general, where if I'm getting longs that are printing by punting this very kind of scary looking higher low structure, it's not the right environment, in my opinion, to be holding that past resistance. But that in itself ends up being an attractive trade. Now, just my only reservation is the following. Well, first of all, yes, there is a bit of difficulty created by the gap between where the daily level is and where the weekly level is. So for example, let's say you buy the daily level and then the market trades through it. You're not technically wrong from a market structure point of view. It's just you have to sit underwater and then potentially assess if you're going to get the deeper higher low at 38.2K. So that's slightly uncomfortable. And then the second thing that makes me slightly averse to this is that I don't really like this entire kind of technical structure that the market formed before making the higher high, or even tentative higher high. That could even be another critique. But generally, the kind of supports that I like to trade are the ones that are built horizontally, where you know there's a lot of trading and volume accrued within a certain price point. When you get this type of diagonal tomfoolery, where it moves like this and looks like a full engulf and then just completely pumps, you don't tend to find much support built at diagonal structures. More so, that tends to be a feature of horizontal structures. So that's the only kind of other reservation about the higher low play. But surely, you know, from a probability, given its weekly support and also risk reward standpoint, it's not the worst setup in the world. It's just something to be aware of if the market should trade back to 38K. So for the bulls, that leaves two options. Either get weekly acceptance above 47K, which would really make the case for a move from the range midpoint into the range high. So that long scenario would be the bullish continuation one, or momentum continuation setup. And then the pullback setup, which are always scarier to trade but generally offer better risk to reward, would be a pullback into this area of high time frame structure from 38 to 40K, as I'm sure Don has discussed, which looks something like this. Your invalidation is probably around the low made, with a first trouble area of this 47 to 43K level. And the risk reward can be skewed to look a lot better depending on where you do business exactly. But purely from a market structure point of view, if this is going to be bullish, it either has to be bullish above resistance or it has to put in a higher low, with 38K-ish being the prime area for a higher low. If it's neither of those scenarios, then it's simply bearish or choppy or not attractive. So only bull setups that make sense. 1, momentum continuation requires weekly acceptance above 47, target 58, or 2, do or die. Wow, this looks shit. Now or never, higher low, pullback, max, risk reward, punt, which would take place around 38 weekly basis, with your first trouble area 43, 47, 58K moonshot target. If neither 1 or 2 materialize, long setups, or long trades, I suppose, are unattractive. So we can tell by looking at the price action that this has been a bit of a rough market, right? It hasn't been super pleasant. The price action has been kind of all over the place, not very clean. And in this type of environment, it's worth being selective with the types of setups that you trade. And that's kind of what I've tried to do with, let me see if I can make this any bigger. Yeah, a little bit. There we go. And that's kind of what I'm trying to do with these 2 points, right? If you want to get me to long, either prove to me that you are very strong and give me momentum that actually means something, or pull back into support and make the risk reward of the setup and the proximity to invalidation so attractive and so skewed in my favor that I can't not punt at the last ditch, do or die support, yada, yada, right? Outside of those 2 setups, either be manifestly strong or obviously skewed risk reward. Outside of those, I don't see a case for doing much else, to be honest, especially with where the market is now. The best I can do here is meh, with the proviso that it's close to a decent support level in the daily form of 40K. But really, the kind of trading that's been rewarded in this environment is selective trading and waiting for levels and being picky. And for me, being picky means above 47 or a deeper, higher low pullback that puts me somewhere close to my invalidation. Everything else is really coin toss territory, and those coin toss setups aren't hugely appealing to me, nor should they be to you. Now, very quickly, when it comes to ETH, not much has changed on that front either, to be frank. I'm not sure if we covered it last week, but certainly in the newsletter, free weekly newsletter, trletter.com, we send 1 email a week with all of our levels, analysis, write-ups, etc. No bullshit there. But the basic premise was the market rallied off the lows into this confluent range low resistance thing at 3 to 3.2, 3.3K, whatever that may be. And it's a similar story that resistance did its job, but, you know, no real rollover structure yet. And in terms of higher low support, I think 2700 is a bit shallow for my liking, but that's certainly the next technical level. And if not that, then back at the lows, right? Back at the lows. I do think with ETH, one cool thing that happened is that this bit of price action that we got ended up being a failed reclaim, right? Even if you forget where this level comes from, if you look at this from a recency support resistance point of view, what you had was clear support, breakdown, looks like a reclaim, but fails. So the portion which, you know, the excess of that move, the deviation, if you will, it's very rare that the market will offer you that pattern twice. So it looks like support, turn to resistance. Oh, is this a support resistance flip? No, it has failed. In these types of setups, as I'm sure you've heard me talk about on stream, the probability of this happening a second time, as in the market pushing up and then failing once again, that's pretty low. So in terms of longs, just purely on a chart basis, if the market reclaims 3K and gets back above and has another stab at this level, I think the odds of continuation are much better than the odds of this type of price action happening once again, I should say, once again, and then you'd be able to, in my estimation, some sort of trade from A, the reclaim of 3K, and your first level of resistance. I mean, my eye is drawn to 3600 B. So the weekly time frame, very similar to Bitcoin, you know, resistance resisted and the higher low area is like slightly murky. But on the daily level, you know, there's a setup to kind of keep an eye out for, which is that if 3K gets reclaimed again, the probability of a second fake out is rather unlikely, and you might get some legs to a move from 3K to 3.6K or thereabouts. But again, most of this chart commentary isn't super high conviction. I think I had reasonable conviction as the market tested resistance across all timeframes last week, that we'd see a bit of a churn and a bit of a slowdown. This is the churn and slowdown, and so obviously my views are going to be more moderate, temperate, whatever, because I'm kind of like, meh, structures are doing their job, but nothing to pounce at for the time being. Now, more broadly, in terms of markets, I think some context here would be helpful. Let me just sort my tech out real quick. So, some stuff that I'm thinking about things, if it's at all interesting. So, generally speaking, markets love/prefer certainty, especially investors, right? And the only certainty right now is uncertainty, which isn't great for risk appetite. And I think this uncertainty comes in a few forms. One, quantitative tightening, taper, raising rates, whatever. We can put that under the category of central bank action. 2, geopolitics, Russia, etc. 3, there's some energy stuff going on, certainly in Europe. And then some crypto native stuff as well, which is that large alt unlocks early 2022. And this is in no particular order. Well, I guess maybe in order of importance, but certainly the first one is the most important one. And then high time frame technicals looking shite, indicators pointing down, trend, etc. Okay, so this is kind of these are kind of the headwinds that we're up against. If in terms of order of importance, I would say this is the main one. So essentially, as the market was going up after the COVID meltdown, the main argument was that central banks are providing a lot of liquidity. We've got unprecedented monetary expansion, unprecedented fiscal expansion, and the whole world is crunching together to combat the pandemic, right? And that this kind of zero rate, low rate, balance sheet expansionary environment is positive for risk assets because of the abundance, if not excess, of liquidity. And there's even a saying in traditional markets, which is don't fade the Fed, which is to say that when the Federal Reserve takes action, which skews one way or another towards asset prices or liquidity or asset purchases, balance sheet, whatever you want to, however you want to wrap that topic, don't fade the Fed, as in don't step in against that action. Now, what we're seeing right now is essentially the opposite, right? Where the Fed has reversed its course and inflation seems to be high and it appears to be sticky. And the reason the markets are reacting the way they are is not because market participants, well, yes, there is kind of a mechanistic explanation behind real purchases reducing in March, etc. But really, most market participants at this point know that inflation is high, and they also know that the Fed is going to take action. The main question to answer at the moment is the rate at which the Fed is going to take action, right? You could even see a case where the Fed decides to raise rates, but if it's on a more conservative or slower or more dovish schedule than planned, that might be actually bullish for risk assets in a kind of weird way. But what we've been seeing at the moment is, especially from certain members of the Fed or voting chairs, whatever, is that there seems to be an appetite for an accelerated timeline of quantitative tightening, tapering, raising rates, combating inflation, and taking all those measures, whatever they may be. And that's what the market is kind of wrestling with, not that whether there will be an intervention and tightening from central banks, but rather the rate of that intervention and tightening, and whether it's going to happen faster than market participants have kind of expected or pricing it, etc. So it's not really about, it's not fully about, oh, there's going to be tightening in March, therefore stuff is going to go down. It's more to do with expectations at the moment, although yes, there is something with, something to be said for the physical tightening itself. TLDR, it's about, there's now an expectation for central banks to act, and what the market cares about at the moment is the rate of change rather than the change itself. Okay, that's really the main thing, and that we've seen that with affect risk assets all over the place. Crypto isn't some sort of risk-off haven gold standard thing, right? We trade like a risk asset, and that's been evident with our correlation with the S&P 500. So in terms of uncertainty stuff, this is certainly the main one. To what extent, and how quickly are central banks going to step in to handle or tackle inflation by raising interest rates in 2022. There's geopolitical stuff, which generally isn't bullish for risk assets, Russia-Ukrainian border type of stuff going on. Energy, as mentioned, all kind of feeding into the same thing as well. And then now the crypto-specific points are large altcoin unlocks happening early this year, among some big names as well. But the argument there is you have a weak market and a lot of supply hitting the market, and that's going to push prices down. And there could be some sort of spillover or contagion effect to the rest of the market as those names get sold or unlocked. And the fifth point, which again is somewhat related to the fourth, is that even in a complete vacuum where you don't know about tapering and politics and energy crises, you don't care about any of that, the high time frame technicals for most of the majors, especially Bitcoin and ETH, do not look constructive and do not look positive at the moment. All the trend following tools, the slower moving ones, the 21 weekly, 200 daily, whatever that may be, the market is below those points. Market structure is bearish on most timeframes, especially on the weekly, where you've got lower lows and lower highs, and the charts aren't fully indicative of a risk-on type of scenario at the moment. And I've always argued that the reason high time frame market structure is such a useful indicator is because it takes a lot of money to move around high time frame market structure and to really shift trends on daily and weekly time frames. So the TLDR on this kind of stuff is, I think if you trade the charts on their own, if you stick to the high time frames, you'll probably be fine. What I think is probably unwise is if you don't have a particular edge in low time frame trading or swing trading, whatever it may be. I mean, it's self-explanatory that, don't trade if you don't have an edge, but especially if you've noticed an erosion in your edge by a change in conditions, be it more down and or sideways, or as the correlations have tightened up, your setups aren't working as well. I really think the most useful overarching message I can give is that this is a terrible environment in which to rush and or force setups. It just really sucks. I think as cliche as it sounds, capital preservation, which is a boring one, but more importantly, being very picky and conservative with your setups. So picky in terms of when to trade and conservative in terms of your targets for those trades. I really think that's going to be the difference maker for the period, the period we're in right now. I'm not a macro guy. I'm not going to pretend I'm an expert in all of this. I can just kind of see where the narratives are and how they're impacting price. As I said, I think the central bank inflation interest rate stuff is the main one, and that's really the one to watch. But even if we get some surprisingly dovish or even more hawkish news, etc., from then onwards, all things equal in a vacuum, I think paying attention to daily and weekly market structure is very unlikely to lead you down the wrong path. So for now, picky with setups, level to level, wait for conditions to change. And I just think don't rush and don't try to incorporate too many new things into your system is probably sound advice for now. Not financial advice, obviously. I'm just talking to myself and the hallucinations in the room with me. That's all I've got for now. I know this is a bit long and ranty, but hopefully it was helpful. Let me know in the comments if you prefer this type of format, if the markets suck, and I will see you on Friday or Monday. Take care. Happy Valentine's Day. Go call your mothers at least and tell them they're wonderful ladies. If you don't have a girlfriend, boyfriend, whatever, just be nice to each other. Bye.